first of all, it's not very hard to explain why the secondary market has been growing at like 15-20% a year, but it's also not very hard to imagine that it will continue to do so, because these two trends are expected to continue.
Hello, my name is Abhilash Jaykumar, the co-founder and managing director of Tres Vista. On today's Tres Vista talk, I have the pleasure of being joined by Vivien Blossier, the head of European LP secondary investments at Intermediate Capital Group. ICG is a global alternative asset manager providing capital to help businesses develop and grow, investing globally, creating value, and growing sustainably, and they manage nearly 70 billion in AUM. Vivien, thank you so much for joining us today.
Hi, Abby. Hi, everybody. Thank you so much for having me today.
The world of secondaries has been evolving rapidly over the last several years, and ICG has been at the forefront of that. And I want to talk about what you're doing in the secondary market. But first, I'd like to take a step back and kind of talk about how you got to where you are. You've had an interesting career, starting with exposure to emerging markets in Tunisia, then going into investment banking, but focusing on energy and power, then moving over to private equity, then moving over to fund of funds, and now running a secondaries team. Can you maybe give us a little insight into how you progressed in your career and how you made the choices you did along the way?
Sure. So that's right. So after graduating from business school, I started my career at ECP, Emerging Capital Partners, which is a US private equity firm dedicated to the African continent. I loved the job there. I felt very grateful that I had the chance to work in direct PE right after the end of my studies. But I quickly also realized that I had chosen quite a narrow career path by specializing on African opportunities very early on in my career. So I decided to follow a more traditional career path, and I joined Bank of America Merrill Lynch, as you mentioned. I worked in the investment banking division there. I spent another few years there. It was a great experience as well. I learned a lot in terms of modeling skills, in terms of attention to details, all the things you would expect from an experience in investment banking. But I quickly missed working on the buy side. So I decided to look for another job in private equity. And after some intense thinking, I decided that I wanted to go back to PE, but I wanted to avoid being too specialized. I wanted something quite broad because I thought it would be more interesting, and also it would give me more opportunities later on. I heard about the secondary sector, which was still quite a niche sector back then. And so I became immediately interested in it. There are many things that I love about secondaries. Obviously, first of all, I love investing. It's a real passion for me. But also, the secondary sector is quite broad. It allows you to learn about new businesses every day. It's also very dynamic. It's very fast-paced. You should be able to close a lot more deals per year than in a direct PE shop. And finally, it offers very attractive risk-adjusted returns for investors, which always made me think that it had a great future ahead as a sector. So on the back of that, I decided to join Pomona Capital. I chose Pomona because, well, number one, it was and it is a secondary pioneer and a specialist. And also I was impressed by the quality of the people there. This was the right choice for me. At Pomona, I had the chance to learn pretty much everything I know about secondaries. And I got the chance to learn alongside some of the best secondaries professionals I know. After a few years, though, I decided to move on and join the secondaries team of Unigestion. The fund we invested was much smaller, but the responsibilities I was offered were wider. So this was the right move for me. But then in 2019, Oliver Gardy, my ex-boss at Pomona, called me back and told me about his ambitions to start a secondary LP business at ICG. So I was thrilled to rejoin him, and Ryan Levitt as well, who also used to work at Pomona. And I was thrilled to start on this new challenge. So I've been at ICG for 2 years now, and I'm very pleased with what we've achieved. We've built a great team. We've done great deals, which are all performing ahead of expectations. And very recently, we launched our fundraising. So it's all very exciting, and you know, we're very keen to continue on the good work that we've done there. If I had to summarize my answer, I would say that I've been very lucky to work in various fields, such as direct PE, investment banking, and secondaries. I chose secondaries because it fits my profile and because it offers very strong risk-adjusted returns to LPs, and therefore I think it has a great future.
You've been in this industry for over a decade. How has it evolved in that time?
Well, so it's been a very interesting journey. It's when I started, the market was still quite niche, and many people had not heard about it. I think by now it's grown tremendously, about 15-20% a year for the last 10 years, and actually even for the last 20 years. So it's seen some very strong growth, and as a result of that, it's becoming less niche, and people know it more, which is kind of a positive circle in the sense that people hear about it, therefore they're interested in it, and they're interested in selling assets, and it makes the market grows bigger, which means that more people hear about it. So it's in this very positive trend, which has been very nice to witness for me. The reason why it's grown so well, I think it's a question of two things. First of all, the supply side, and second of all, the demand side. If I look at the supply side depends on two factors: the stock of assets under management in private equity and its annual turnover, the percentage of assets that sell every year. And the stocks of assets under management in PE has continued to grow over the years. It grows at 10, 15, 20% a year, depending on which year you look at. So even with a flat turnover, you see the secondary market growing at least 10% a year, with probably an average at 15. The annual turnover of secondaries has also been growing over time. It's about 1% today. People think it will continue to grow. And so if you put these two trends together, it's not very hard to imagine that first of all, it's not very hard to explain why the secondary market has been growing at like 15-20% a year, but it's also not very hard to imagine that it will continue to do so, because these two trends are expected to continue. So the supply side is very positive, as we've seen some very positive trends. On the demand side, the dynamic has been very healthy as well, and that's for one simple reason. The secondary market is very appealing to LPs. It offers very compelling risk-adjusted returns. There's this very famous chart that you can find in Preqin, which shows you the risk and the return you can expect in various segments of the PE market. And it clearly shows you that within PE, secondaries is one of the most, if not the most appealing strategy to invest in. Basically, you can make the same returns as in the buyout sector, but with much less risk. All the other strategies are less appealing. They offer less returns than the secondary market, despite the fact that they're actually riskier. And so that's why you've got this very strong demand from LPs, for secondaries. So as a conclusion to your question, I'm pretty confident in the secondaries market future growth, thanks to these positive trends I've just highlighted, both on the demand and the supply side.
One of the first teams we worked with at ICG when Trust Vista first started this relationship was your GP-led secondaries team. Today, you're launching a LP-led secondary strategy. Can you talk to me a little bit about what the need for launching a separate strategy is?
Sure, indeed. We are launching a secondary strategy solely focused on secondary LP deals. as you probably know, most of our competitors tend to do both LP-led deals and GP-led deals out of the same fund. At ICG, we have two different teams and two different funds. There are several reasons why we have split the two strategies. First of all, these are fundamentally different products, and having a team fully focused on each one of them just makes more sense. And second of all, our LPs at ICG are asking for it. When they commit to most secondary funds, they don't really know how much exposure they'll get to each strategy. With us, you can decide for yourself how much exposure you get to GP versus LP deals by making separate commitments to each fund. There are a lot of LPs who want exposure to LP deals only. By committing to our fund, you'll benefit from high quality assets, compelling returns, limited risks, early and frequent liquidity, a high diversification, no J-curve, and finally, you'll benefit from a fund that is already partially invested. So I believe it's a pretty exciting product we're putting together.
And, you know, you previously mentioned the risk return profile for the secondaries market, and that, you know, it over a period of time has clearly shown outperformance relative to the risk that you're assuming in, as opposed to traditional buyout. Now, how much of that do you think is because of inefficiencies in the secondaries markets historically not being as broadly covered as a sector, versus how much of that is just inherent to what the strategy is?
I think there's a little bit of both. So historically, indeed, it was a pretty inefficient market, especially at the very beginning of it. I mean, the real beginning was in the 90s. You only had a few players doing secondaries back then, and the returns were you know, very, very strong. But with time, the market, the secondary market, has become more efficient, and despite that, the returns have remained very strong, and as I mentioned before, one of the best within the various PE asset classes. So this tells me that it's not just about efficiency; it's about what the secondaries market offers. And the reasons why the returns are so compelling are numerous. But I mean, some of them are, well, first of all, when you do secondaries, you have a very good visibility on what you're buying, so you're taking very little risks. The assets are already invested, they're in the ground, you can see how they're performing, so you get to take limited risks by buying these assets. The other reason is you come into funds once they are, you know, just before, you know, usually after 3, 4, 5 years. So you come at a point where value creation is about to accelerate. A lot of GPs will keep their valuations quite, you know, if not low, at least they'll keep them under control, just so that they can show nice pops.
Manage expectations.
Manage expectations, show nice pops at exit, and basically deliver better than what they've told people. And so you come in, you know, after a few years where the returns have been kept low by the GP, and you come in and you get these nice pops. So, you know, it's these reasons that make it a very appealing sector.
And how have the motivations for LPs to actually trade their stakes evolved over this time, right? Is it portfolio balancing? Is it need for liquidity? What really drives LPs to want to exit from a fund that they've been an LP in for a number of years?
So there again, the market has evolved quite a bit. So initially, when, you know, 10, 20 years ago, I would say 20 years ago, the market was going back to what you were talking about, inefficient. And so the people who sold were usually people who had no choice. So it could be for many reasons. They could, they could just need the money, or need to restructure their organization, and need to sell their PE exposure. After the 2008 global financial crisis, you had a lot of people who had to sell due to regulation reasons, due to regulation. And so you had a lot of people who were, under pressure to sell. With time and with the market growing, it's become much more of a mainstream product, where actually these days you have a lot of people who just sell because they want to reshuffle their portfolio, or they want to move on from certain strategies, or from certain GPs, or from certain areas of the market, or from certain vintages. So there's many reasons why people choose to sell these days, and a lot of it is active portfolio management. So the market has a bit evolved from, the early stages where it was a lot of people pressured to sell, to today, where you have a lot more active portfolio management. And in that period, returns have remained very, very attractive. So, it's been great to witness.
Now, taking a further step back, when you started your career, you started in a circuitous path to get into secondaries. Now, as secondaries have more prevalence, people are learning about them while they're still in university, and there's career opportunities to start in secondaries right out of the gate. What are the mistakes you see young professionals making in this space? What advice would you give to someone who's wanting to build a career in secondaries? And I think this is important because from a lot of my conversations, I feel like one of the limiting factors to the growth of secondaries as an industry overall is availability of senior talent. This is a fairly young sector within private equity, and the individuals like yourself who have 10 plus years experience, you can probably count. So as more people come into the industry, what advice would you give them to build a career in secondaries?
So first, in terms of recruitment, we hire mainly investment bankers in our field, because we need, driven people that are very strong at modeling. In my experience, when they apply, I think that one of the main thing that bankers need to be careful about is they need to show some investor mindset. Banking is a very different field, where you're mostly required to execute what your clients want. We need people who already have some sort of commercial judgment, or at least the premises of it. We need them to be able to explain what assets they're interested in, why they think those assets are compelling. We need them to think for themselves, and be able to, build judgment on assets. I guess the best way for someone to train on that is to get close to your clients, like for a banker, is to get close to your clients and understand their strategic priorities and why they got excited about a deal. The other factors that we look at are pretty much the usual ones, so I'm not sure if it's that interesting, but we need people who are motivated by the opportunity, that are not shopping around. You'd be surprised by how many people come unprepared for interviews. I guess the next step is to talk about, once they're hired, I think there's a lot I could mention, but all of it is pretty obvious. But so what we need is people that are very strong at modeling. Working in secondaries requires very strong Excel skills. We need people that are proactive, willing to learn, people that want to broaden their skill set at any time in their career, that want to keep learning. We need people who understand business models, who are interested in, digging into companies, understand how they operate, understand what makes them attractive or not. The other advice I would give people is young people is to get out there, meet other professionals, build a network, and to get out of your comfort zone, push yourself. Maybe finally, one piece of advice I would give juniors is not to be too focused on competitors, on who is doing what. It's good to read about competitors and to stay informed, but what you should really spend your time on is becoming a great investor. It's about spending the time to understand which assets you want to buy and why. In the long term, this is what I believe will make a career successful, because you'll make the best deals, and once you make the best deals, you'll achieve the best risk-adjusted returns for your LPs.
Obviously, secondary markets are quite different across geographies, and you specifically are focused on European secondaries. Can you maybe just talk a little bit about what are the differences, behaviors, practices, performances in the different geographies that you think about?
So yes, I mean, we, as you mentioned correctly, my colleagues and I are launching a secondary LP strategy which is focused on Europe and the US, because we believe that's where the best risk-adjusted returns and opportunities are. And also because I'd rather focus on what I know well, where I know that I can find deals with compelling returns while limiting risks. We are pretty skeptical of other markets. I mean, other people have made it work, but we are pretty skeptical. As I mentioned, for instance, I worked in Africa at the beginning of my career. I really don't think the risk is worth the reward there. There are just too many issues and too many risks, whether it's geopolitical, state of law, currency, and so forth, and so on and so forth.
Yeah, and obviously the critical mass of assets to invest in are obviously going to be much greater in Europe and US as well, as they have the more developed private equity markets. How important is ESG in the funds that you invest in? Obviously, it's a hot topic across private equity today, and it has been much more so in Europe than it has been in the US for a long time. Is that a part of your investment framework?
Yes, definitely. So we have very clear ESG rules in our fund that we follow very closely. First of all, because we want to be responsible citizens, and second of all, because our LPs are asking for it. Now, in secondaries, the chance that we have is that most PE shops now, direct PE shops, the ones we buy stakes into, have taken ESG into account. So we're able to do the work and check that they are ESG compliant because they've done the work themselves.
Is there any situation as a secondaries fund where you make an investment fund and you exit to another secondaries fund prior to an actual sale of a portfolio asset? Or is the strategy always to hold till maturity?
We've seen people do that, and we will also do it if it makes sense for the deal. What can happen is you do a deal, it's performing very, very well, but then after, I don't know, 5, 7 years, 10 years maybe, you have a tail of funds that are still in your fund and that you may want to sell, because selling them will not change the profile of your fund, and it will allow you to move on and return all the money to your LPs. So a lot of secondary buyers are also sellers when it makes sense to them.
Okay. Now, obviously, in the last couple of years, it's been a very unusual time for the whole world, and private equity has had some interesting changes as well. From 2020, funds weren't getting raised, funds weren't getting deployed, which pushed out kind of the cycle of allocations for a lot of LPs, pushed out the exit timelines for a lot of portfolio companies. And in 2021, you saw a frenzy of deal volume, valuations, going through the roof in some situations. What's your outlook for the future of not just private equity, but for secondaries?
Well, so as I mentioned earlier, I have the chance to work in a market, the secondaries market, with a lot of tailwind. I mentioned that the secondary market has been growing very well in the 15 to 20% range per year over the medium to long term. And most people think it will continue to grow at these rates for the reasons I mentioned earlier. But like every other market, it's gone through some up and downs. But overall, it's been quite an appealing market, if not the most appealing PE market to invest in. Having said all of that, I mean, it's true that there are some risks out there. I mean, there always are risks. When you look at financial markets today, you can see various risks. I mean, for instance, valuations in equity markets in general seem high, leverage as well. People seem very bullish. There are a number of global issues that you should watch carefully: inflation, supply issues. But to be honest, I think that at any point in time, there are always risks and opportunities in the market. You just need to keep the discipline to make sure that you only do deals that present, attractive risk-adjusted returns. If you focus on fundamentals, you will make money for your investors. You need to do the work, protect your downside, and look at deals that offer more upside than downside risk. At ICG, in the LP secondaries team, we do this through different ways. We do deep dives into the assets that we buy. We focus on deals where we have a very strong angle so that we can negotiate and customize the deal to fit our needs. Pretty much everything we buy is buyout funds because these tend to outperform other PE strategies over the long term. We focus on deals where the assets present a lot of growth while being reasonably valued, usually a few turns below comps. On top of that, we usually assume some multiple contraction, even though you tend to see the opposite in PE, where managers tend to sell at an uptick to the most recent valuations. We focus on assets with reasonable leverage. We focus on top quartile managers and funds, top quartile funds, because over the long term, these have tended to outperform. We look for deals that can generate a lot of liquidity early on and de-risk fast. We structure deals to protect our downside. And finally, we usually get a nice uptick right from entry. I mean, it always helps when you can show a deal that a deal is doing well right from day one. So doing all of that allows us to select and craft the most compelling deals and to partially protect from downturns and headwinds. And that's why even though I think today there are a lot of risks in the market, I think that our strategy will continue to do well and we'll continue to find attractive opportunities for our LPs.
Well, fantastic. Well, Vivien, I want to thank you so much for taking the time to speak with me. It's been really insightful, and I appreciate you sharing your thoughts.
Thank you so much for having me. It's been a great pleasure.
And we're very happy to have been your partners from the early stages of your growth and look forward to growing together.
Thanks for that. You've been great, and we look forward to continuing the work together.